T.S. Lombard, does a recession even matter? Now we're going to cover whether or not a recession actually matters in the eyes of T.S. Lombard. Now, I think this is very interesting, and they give some fascinating perspective. So let's take a look at this. 2020 has given investors a false sense of security about the recession impact. Now, look, most of you know I'm pretty bullish right now, mostly because the conditions that we see in the market today are highly the opposite of the conditions that we saw in January of 2022, where in January of 2022, the conditions of a wage price spiral were in place. Everybody was raising prices. Pricing power was insane. Supply chain shortages were insane. We knew the worst was ahead of us. Now, a lot of those conditions have really started their reversal path, and even though that reversal is taking substantially longer than expected, we're not facing the sort of Paul Volcker scenarios that we were potentially facing in January of 2022. However, I like to read sort of the more bearish pieces, and I think it's very interesting that they start off by saying, 2020 gives people a false sense of security, that basically in 2020, as they say, was a joke, basically, about how the market responded. Because, and I remember this during the COVID pandemic, the stock market, the entire economy basically got shut down in March. And then in April, May, everything is a disaster. Everybody's afraid of COVID. Everything's hell. And the stock market's just going straight up because the Fed's printing money like crazy. And I remember the memes of the child on the swing, smiling and laughing, being labeled the stock market, and in the background, the whole town is on fire, being labeled the economy, right? And that disconnect, those memes I'll never forget of 2020. And so they bring up basically this joke. They don't say it's a funny joke, but basically a joke about how the stock market is not the economy. Because back then, we really had this element of Tina. There is no alternative to investing in the stock market. And so what they argue here was that the big thing about the fake 2020 recession is that if your only real experience of a recession, like this is if you're maybe like in your early 20s or before, like if you weren't essentially of adult age in the 2008, 9, 10 sort of depths of the recession, or potentially even 7, 6, they make the argument here that the 2020 recession might be people's only actual experience of a recession, and that was really a fake recession because the government knew they were shutting down economies, and they preemptively printed so much money to backstop financial markets. We basically didn't actually have a real recession. Yes, GDP went negative, but we didn't actually allow real damage to occur from the lingering of a recession. Now, what I think is interesting here is it somewhat relates to me what some of what Elizabeth Warren said yesterday. Now, we know that Elizabeth Warren is pretty far, relatively, dare I say, extreme on the left. As somebody who enjoys financial and political coverage in the middle, I see Elizabeth Warren as quite left. Not just left, quite left. But anyway, she made this argument that, hey, look, once you start seeing layoffs in the economy, you're going to create this, quote, runaway train of more damage occurring. How are you going to prevent that continued damage? And she actually has a really good point that we don't know what is going to happen in terms of how long the damage of the recession could actually last. The Fed could U-turn when inflation is under control, but then you look at the pieces of the economy and you go, well, what did you just do to the economy? What if now we go into a real and deep recession? Now, we don't know. We don't know. We haven't had these sort of experiences before. So we don't have a very clear precedent of war and pandemic, and a pandemic that was responded to with the money printing that we've seen, right? We've had wars, and we've had pandemics separately, but not both together. Combined with these modern supply chain issues, we haven't been in these situations before. But anyway, the stock market performed during an artificial environment during 2020 and 2022 is not necessarily a helpful guide. Recessions, they say, are a process, not just a period of 2 consecutive quarters of falling GDP. In fairness, in last year, in 2022, we had 2 quarters of negative GDP, but we did not have the recessionary process. Now, that actually led to a lot of complaining that Joe Biden was trying to rejigger the definition of a recession. Like, hey, a recession isn't actually just 2 quarters of negative GDP. And everybody's like, of course you're saying that, you're the White House. But to some extent, the White House isn't necessarily wrong. Like, we didn't really have the quote unquote process of a recession in 2022, even though we did have 2 quarters of negative GDP. It didn't really feel like we were in a recession unless the only thing you cared about is the stock market. But the stock market, as we know, is not the economy. But anyway, recessions are a process, it says here, not just 2 quarters of falling GDP. And they center on deployments in the labor market, particularly in the United States. When U.S. companies start to fire people, it sets off a highly unstable and reflexive process because falling employment in turn kills consumer confidence, reduces spending, and feeds back into a decline in corporate revenues, which could lead to further job losses. Now, I find it very interesting, but this is literally what Elizabeth Warren was talking about. And I can't believe I somewhat find myself finding basically an institutional piece of evidence that reiterates what Elizabeth Warren says, because I generally don't like to amplify what people on the extreme say. But she's right. She's not wrong. We don't know what happens when unemployment starts to rise. And then we get that potential runaway train. And here T.S. Lombard is telling us, yeah, the 2020 recession didn't matter. But this recession we're about to go through, this could actually be a really big problem. Falling unemployment in turn kills consumer confidence. I mean, think about it. You lose your job. All of a sudden, you're like, oh, damn, I'm not going on vacation this year. Now, in fairness to myself, okay, well, I'm not trying to sound conceited here, but I've been pounding the table since March of 2022 and January of 2022, around that region. The reason I say March is because I did an interview with a good friend of mine, Matt Reisinger. I love the guy. I got to go visit him in Texas. And I remember going on his podcast, and I said, if you're a contractor right now, just get ready. I don't know when, but probably over the next 1 to 2 years, you're going to be in a recessionary environment, and you want to get ready. Start saving more money now, right? And I'm trying to provide that warning, get ready. Now, I'm glad I did, because, the building permits are starting to fall. We're starting to recognize that there could be lagging effects that affect the construction market. In fact, I thought it was very fascinating. There's this researcher who put together a phenomenal piece this morning on the lags of construction data and how that potentially affects real estate. I'm going to go ahead and pull that up right here, because and I'll give you some bottom lines on it too. I'm not going to go through the whole thing on it, but let's see if I could find the darn thing here. Here it is. EPB research. Okay. And I'm going to bottom line this because it's a little bit long-winded, and that's no offense to him. He's providing data, but we're going to just keep it simple for the sake of YouTube here. Although usually I go into more detail on YouTube. This one is not as necessary. I could sum it up faster. So basically he talks about construction being a major driver of recessions. And essentially what he's saying is construction is really broad. It's really residential construction that leads recessions. And the really fascinating part here is he talks about how building permits are one of the most reliable indicators of construction, because obviously you need a building permit before you can build. And he talks about right here, building permits, blue line, recession, gray bars. Okay, so what do you have? Before the recession of the early 70s, what do you have? A massive drop-off in permits. What do you have before the late 70s recession? Massive drop-off in permits. What do you have before the 82 Paul Volcker era? Massive drop in permits. What do you have before the late 80s recession, the 89 recession? Drop in permits. Not very soon before, or not very early. It's not like a super leading indicator of recession. But what do you have over here before the housing recession? Obviously, massive drop in permits. And look at what you have now. Massive drop in building permits. And I thought it was a really fascinating piece, because he's really saying, hey, hello, the leading indicators are screaming that we're basically barreling towards a recession. He says, when you see a big decline in building permits, some number of months later, the number of units under construction will decline. And this is sort of aligning with sort of my idea that, if you're a contractor, get ready. And I've been saying that for a year now, but I mean it. When the number of units under construction starts falling, construction employment falls almost instantly. Remember, construction employment has residential and non-residential components. Residential labor tends to react more clearly with the actual economy, because you could have, institutional, government, for example, construction, like roads or highways or whatever. Those tend, well, I shouldn't say tend, but may be more recession agnostic. And they're not as you don't turn those projects as quickly as you do a house, right? You could build a house in 3 months. Building a highway could take you 3 years. So that's why you get more responsiveness for residential construction. But anyway, basically he talks about how going back to the 70s, there have only been a certain number of times where building permits declined 20%, and pretty much at all of those times we've seen a recession, and we have basically that showing up again. And then he talks about how there's about a 6-month lag between when permits fall and when construction jobs start falling. And I think that's a fascinating warning, because he's basically giving us a leading indicator that, like, hey, like, this could actually reiterate what Janet Yellen is saying here, and maybe we should be careful on how much we tighten, because if we do get this runaway train, there are a lot of actual lagging indicators that suggest we're running into problems. Look, Minecraft Steve is here, as Jack described to you yesterday, saying lumber prices probably are an early indicator as well. Steve here says construction is the number 2 GDP driver in Canada after real estate. Oh, look at that. Steve, what part of Canada are you in? I'm going to come visit you, and then we could talk about garages, eh? Okay, sorry, bad Canadian jokes. We'll trade loonies and toonies instead. Okay, so investors can be sure. Remember, my family is half Canadian, so I feel like we get to make those jokes and then have beer. We'll go to LCBO if you're in the Ontario area, just as long as it's in accordance with their hours, because they have weird operating hours. Anyway, investors can't be sure how deep the recession will be, when it will end, or whether there will be a strong and full recovery. But we can agree that a recession should be in the mind of investors, right? And we want to be aware because, right now the assumption is that the recession is going to be mild. But a big red flag that you want to pay attention to is every recession is assumed to be mild. Now, I think that was actually really interesting. What's up, Max? I'll come visit you in Toronto. That's only like 30, 40 minutes from Barrie, depending on traffic. Anyway, this I thought was really interesting because, yeah, everybody right now is like, okay, if we have a recession, it's going to be mild. Well, dude, I remember 2006, and you know what realtors said in 2006? They're like, we're just going to have a leveling off of home prices. It's just going to be leveled off. It's just going to be mild. Dude, it was not mild. It was hell. It was hell. Some condos in many markets fell as much as 55%. It was insane. If true recessionary dynamics kick in, at which point people start to feel uncomfortable with the mild recession thesis, there will be a particular point of danger for risk assets, and will be particularly dangerous if the response from policymakers is less preemptive than everyone has been assuming. In other words, well, inflation is still up, we effed, and we're just going to have to keep hiking. So in other words, every recession is supposed to be mild until it isn't. This is like... quite frankly, like chilling, this piece right here, especially when you combine it with leading indicators, Elizabeth Warren and Jerome Powell, and this piece here. This is bearish. I don't like this, right? Even if it lasts only a matter of weeks, the combination of rapidly deteriorating economic data and residual monetary hawkishness could substantially destabilize global markets. Investors are focusing on the softness of the soft landing, but even a soft landing could be disturbingly bumpy. Corporate earnings could... so then we get into one final thing about a normal recession is we don't know what sort of economy will emerge on the other side. Often the whole trajectory of nominal GDP turns lower, which means corporate earnings are permanently reduced compared to what investors expected before the downturn. A more subtle point is that sectors that performed well during the previous expansion might not be the growth leaders of the new cycle. Take famously the mid-2001 recession. Manufacturing in the developed world never fully recovered, with many of these industries migrating to China and developing economies out of the U.S. U.S. tech companies suffered years of structural derating, with Europe and emerging markets experiencing the best period of outperformance in decades. It is possible we could see another big rotation after the next recession, particularly if underlying inflation pressures were to linger and there was no return to quantitative easing and this is basically near zero interest rate policies of the 2010s, which had previously given stocks distinct advantages. So we can tell ourselves the next recession doesn't matter, but it is likely to be mild, especially if we manage our own jobs. But that view could well be tested at some point this year. Ooh, this is a pretty damning piece on the recession, and how does this affect my likelihood of flip-flopping? Well, right now it doesn't. I'm going to be, as the Fed says, data dependent. I think our trajectory is substantially different than that, again, of where we were in January of 2022. However, this is a very good point. And this is something that I'm going to put on my bear belt. So I like to say I have a bear belt. And so that way, if I need to reach down to my tool belt and go, I got a gun. I got bear information. I can go down and go, oh, this is starting to align. And so every so often, I kind of like to look and go, okay, the bear's argument, they have a point here, here, and here. This is a really good point. I think this is a fantastic bear argument, is that we don't know how dirty this recession could be. We have no idea. And so we just have to see, hey, how's our progress growing? And what is the likelihood that the amount of wealth and excess savings that has been built up will actually sustain us through the recession? Now, somebody left a comment yesterday, which I thought was actually a very fair comment. They're like, Kevin, can you clarify why everybody keeps saying that, the savings rate is down and a credit spending, like consumer debt, is up, but somehow people have excess savings? And this is actually a very weird phenomenon. So let's say you have $20,000 of excess savings, but you're saving zero right now. Your savings rate is zero. So that can be explained away. We can explain away that you have more money while the savings rate is lower than usual. That's fair. But then why is debt going up? Well, it's financially stupid, but a lot of people do this. They will actually look at money in their bank account and say, yeah, I'm going to keep that. That's my safety net. Now I'm going to go spend on my credit card and borrow more money. It's generally a terrible financial decision to pay interest on a credit card while you have money to pay it off. But people do it. I don't know why. I don't think it's a good idea, but it does happen. So the conditions are definitely present for some bearishness. But we'll see how the leading data comes out over the next period of time here.